Okay, so now moving on to the substantive testing piece of designing the audit procedures. Um, and this is where we're collecting the main set of evidence that we can directly tie to a financial statement account balance. Okay, a financial statement line item balance. And so this is really the heart of auditing, is collecting evidence through these substantive tests. So we've done a lot just to get to this place, but it's because we want to make sure that we direct our testing in the right way. Okay, so again, we're going to have to tailor it to the firm and how the firm is set up and what kind of accounts we're talking about, how they process sales transactions, how they set up accounts receivable. But there are some common elements that are, or at least they're frequent. There are some tests that will be done frequently across lots of different audit clients, and so we can look at some examples here. Okay, so um, one thing we can do uh, that, well, we can do several things. Um, uh, this number 4, it's not letting me draw. That's unfortunate. This number 4 here is probably the most common, or one of the best tests we can do, where we're doing a confirmation with our clients' debtors. And debtors just means people that owe them money, right? So usually this is customers, but it could be, right, remember those other sources of accounts receivable we talked about, in terms of executives or other companies or subsidiaries or things like that. But most of the time we're talking about customers, right? So we're doing a confirmation or a series of confirmations similar to the bank confirmation that was talked about in the cash topic. The receivable confirmation is also a form, or again, using something like confirmations.com to send a request to those customers or others that owe our client money and say, okay, our client says that you owe them this amount as of the fiscal year end date. And so then what we're expecting then is for that individual or that company to reply back and say either yes, that is an accurate amount, or no, and either this is the balance we show, and hopefully there's some explanation if that balance is different from the balance on the company's records. Okay, and actually if we look at the next page, we can kind of see these mixed in with the assertions, and I think that might be a helpful way to go. So we have here again kind of this confirmation being a big one. And again, what does that help us with as far as audit objectives related to accounts receivable? That would be existence, in the sense of helping us get comfort around that AR balance, possibly occurrence if we're going to get down to the detail of the transactions, and then rights, right? Does the company have rights to claim this as an asset? Well, if there's a conflict or there's a disagreement over that amount or the validity of that balance, then that calls into question the rights audit objective. Okay, and then the valuation accuracy. Accuracy would get to if there's a different amount. Valuation would get to if, for example, the customer went bankrupt, right, and no longer was able to pay that debt. So that could be how valuation would work in. If we look at and that's AR. Now, obviously, there are revenue transactions flowing through AR, and so to the extent that we have comfort around the ending balance, then presumably that gives us some comfort around the transactions that went through it. But something that would be more directly related to revenue would be looking at the sales contracts that were made close to year end, right? So if the firm is attempting to inflate its earnings, or excuse me, its revenue at the end of the year, one thing they might do is put in very generous right of return specifications or provisions in their sales contracts that are close to the end of the year, right? And so that would get to, okay, how much of the revenue should really be booked, and do we need to have, for example, a contingency set up in the event that any of those items are returned, right? A contingency as far as an allowance goes. And so looking at those sales contracts, you might, sample from the contracts, depending on how many there were, to look for any of these terms that might suggest that we have a problem with recognition, right? And so that would get to things like a valuation of revenue, because do we need to have an allowance, for example, of setup that's a contingency on any of those returns being sent back or being exercised. Okay. Another one would be related to obtaining this age listing of accounts receivable. And that one is all about the allowance for doubtful accounts and the bad debt expense. And so there, what we're looking for is, we have a general ledger account balance for accounts receivable, right? But there's also a subsidiary ledger of accounts receivable, and so we would look at all of those balances, all the basically non-zero balances, and then we would age those receivables based on how old they are. So based on when the items were due or when the invoice date was, how long has it been since then in terms of an unpaid balance. And what that does is it gives me a sense as the auditor of how likely is it going to be that some of these receivables will not be paid, right? Because that's what the allowance for doubtful accounts is. It's basically recognizing that I'm earning revenue in this period, but one of the costs of the revenue is that by extending credit, I am incorporating the possibility that I will not be paid back, or excuse me, that the client is incorporating the possibility that they will not be paid back. And so as the auditor, I want to evaluate, okay, if there is a reasonable mix, and if you did the Systems Understanding Aid project, you had to create one of these, an AR aging schedule, where you would have, okay, you'd list the different accounts receivable, open accounts receivable balances, and then you would age them in 0 to 30, 31 to 60, 61 to 90 days, 91 to 120 days, over 120 days. Put the balances into those buckets based on how long have the invoices been unpaid. And so that's really helpful, because the older the receivable, the less likely it is it's going to be paid back, and therefore the more of that amount needs to be set aside as an allowance. And so the age listing is very, very helpful thing to do. And that's one thing I actually did when I worked for one of the big four companies, is we collect the data, specific transactional data around the accounts receivable, in terms of transactions that increased it, and payments, write-offs, and then we created our own aging schedule as the auditors to then evaluate what the provision for bad debts needs to be, or at least what our estimate would be as the auditors. So that's a very helpful substantive procedure as well. And again, it gets directly to do we need to adjust the dollar amount? In this case, it would be of the allowance for doubtful accounts and the corresponding bad debt expense. And then obviously, you can look at some of these others, if there are any estimates related to revenues and timing of revenues. That depends on the nature of the transactions as well. That can get to valuation and accuracy. So if this is a construction company that you're auditing, obviously a lot of it's based on costs incurred to date, relative to projected cost. I mean, granted, it depends on which method they're using to account for revenue in that situation, but those can be those estimates can have significant variation in them, right? There can be a pretty big range of those estimates. Um, and oftentimes projects go over budget considerably, right? And so those estimates, those impact when revenue um, is recognized. And so one thing you might do as the auditor is look at some of their estimates, and you presumably are going to have access to the history of their projects, and you can look to see, okay, based on initial projections relative to final projections, how much is that changing? How accurate were those projections in the past, to give you a sense as the auditor of how reasonable do you think the estimates are at this point. Okay, and so again, those would be a pretty primary uh, um, test, depending on if that's the nature of the revenue recognition transaction that your client was facing. So again, these figures are helpful for trying to connect the procedures we're doing with the primary audit objectives that they're tied to, right? And so, because again, we want to make sure we're covering our primary audit objectives with enough tests that we feel comfortable as the auditor. Looking at analytics, again, that's where we're taking the population of transactions as opposed to just taking a sample, which is historically how the substantive procedures have looked at transactions. But here we're looking at a population of transactions. So there's a lot of different things you can do in the revenue and accounts receivable space with the right data. Looking for fictitious revenue by looking for unusual entries in the accounts, right? You can basically, using analytics, you can come up with a profile of typical transactions, and then you look for transactions that are outside of that typical range, whether it's dollar amount or frequency or number of transactions. All those things can help. Timing of transactions, all those things can help you identify unusual. And obviously, large transactions are relatively easy to identify using analytics. You can also look for unusual sources for the entries in terms of individuals that are entering the transactions. And so, if you normally have a set of sales clerks that are entering the sales transactions, and all of a sudden you get some manager that's entering in a transaction for a given date, then that would kind of give you pause and ask the question, well, why is the manager doing it in this situation as opposed to the sales clerk? And so that's another way we can look at or look for possible fictitious revenue. You can look for unusual transactions around year end, right? You can develop, for example, rolling averages of transactions or a seasonal average. What's a year over year difference in the number of transactions or the dollar amount of transactions for a given week or month or quarter, and you can look to see if this year's revenue seems unusually large, for example, relative to those other benchmarks. Yeah, you can look for related party transactions as well. Duplicate billings, look for same invoice, same date, or within a certain amount of time, same amounts, those kind of things. Sales discounts would also be a potential area you could invest. Right. Again, you can use the data around credit sales, and this is something that's not too difficult to do. Once you identify customers' credit limits, then you can look for situations where their open AR balance exceeds those limits. And then lastly, as an example, looking for misstatements by looking for these unusual large credits to the AR, right? Large reductions in AR. Um, and so that would be a situation where if you have unusual sources, then that could be a potential problem. So again, these are just some examples of how you could use individual transactions. As you get to know the company and its transaction cycle and the data that it keeps, then you would obviously have to tailor your test to the specific situation in order for it to be the most helpful, right, for getting comfort over those audit objectives. So then looking at some revenue recognition steps here, this is from one of the ASCs. Identify the contract, um, identify the performance obligations that are included in the contract, what's the transaction price, and then you basically allocate the transaction price to the performance obligations, right? This is just kind of a review of the revenue recognition standard. And then recognize revenue when the performance obligations are satisfied, right? But I mean, this is kind of easier said than done. Obviously the challenging part is figuring out how to identify separate performance obligations, but the biggest problem is this allocation, right? That's the thing that's challenging, is how much of the transaction price do you allocate to each performance obligation. Okay, I'm not saying it's impossible to do it, but that's just where the challenge is. That's where the art is, I guess, and where reasonable people could potentially disagree. And we've kind of mentioned these before. Revenue. What kind of problems are we going to see in this revenue space? You have these unusual rights to return. You have these side agreements that are kind of connected to the transaction. Franchise fees represent a potential revenue recognition problem because then the revenue is based on performance of a franchisee. Bill and hold transactions would be a situation where your client is billing their customer for something, but they're actually not shipping out the product yet, right? And so they're just trying to inflate revenue, and so as soon as they get an order, for example, they're going ahead and booking revenue, but obviously they haven't earned it yet, right? So that's the problem. You could potentially have situations in terms of payment being done with notes with these unusual interest rates, and then just in general, long-term construction contracts have lots of potential revenue recognition problems. And then just obviously what we've kind of mentioned before is this multiple element agreements, where these agreements have a lot of different pieces to it, like a product and a service, maybe installation, maybe support afterwards, right? And so these are not simple issues that need to be dealt with, but they're ones where judgment needs to be applied. So how can we get to evaluating these revenue estimates? And we've kind of mentioned this, or I've mentioned a little bit of this already, in the sense of obviously we're going to go through how management develops the estimates, but then auditors are going to actually develop their own estimates as a comparison. And you're going to try and look at history, right? The history of the firm, to see how good their estimates have been in the past. And if you have time, for example, they made some estimates in quarter 4, and some of those estimates bore out in quarter 1 of the next year, as long as it's before the financial statement filing date, then you might have an opportunity to look to see how accurate were those estimates, right? And obviously you have hindsight bias when you do that, and so you have to be careful about that. But we want to get a general sense of how good is management at making these estimates when we're evaluating their current estimates. So we mentioned confirmation before. It's a pretty standard process. You don't have to do it every time. If the AR is immaterial, obviously it wouldn't make a lot of sense to spend all that time for confirmations, sending them out to the customers if the balance is pretty low. If we think it would be ineffective, for example, there's a lot of small customers who are very unlikely to reply to a request of that nature, um, and or if essentially we think, as auditors, we think the risk of a material misstatement occurring and not being prevented or detected is low, right? If inherent risk times control risk is low, then confirmations may not be required in that case, just because now our detection risk, our allowable detection risk, will be higher, and so we don't have to worry about it as much. Making sure that we have a strong nature, timing, and extent of the audit procedures. So the confirmation process is similar here as it was for the banks. So there's two ways we can do confirmations. Positive confirmations is when we're asking for them to reply, right? And so we can either do it with balances on them and say, hey, this is what our client says you owe them, and that's typically the best way to get a reaction. Because if it's wrong, it's more likely that they will reply if it's not consistent with their records. If you leave it blank, then it just feels like it's work for them to do, and sometimes they're less likely to return it. And obviously not obviously, but with negative confirmations, we're basically saying, just let us know if we think this is incorrect. So the problem with that is you're making an assumption that if they don't reply, it's because they think they agree with the balance. But that's only one possibility, right? The other possibility is that they just didn't bother returning it. And so it could still be wrong, you just don't know. And so that one is not used as often. It is a lower kind of scope of the confirmation, right? If you want to think about it, it's not going to give you as good evidence as a positive confirmation will. And so you only want to do that when you think there's a low level of risk of material misstatement, right? The inherent risk times control risk is at a low level. So you typically see positive confirmations more than negative. And we'll probably spend some time on a problem surrounding confirmations and how do we deal with the information that we receive back as auditors from the customers. And just to finish off here, a couple quick topics here. Audit of the allowance for doubtful accounts. We've talked a little bit about this already, right? We're really going to be spending some time trying to evaluate how reasonable a manager's estimate, because that's all of what allowance for doubtful accounts is for the most part, right? It's fairly straightforward to find evidence for write-offs. Either it's gotten so old it's been written off, or they've gotten notification of a bankruptcy and it's been written off. So that's usually not as difficult to get evidence on. It's really the bad debt expense and allowance journal entry, which is the one that needs the most attention, right? And so again, using something like the aging of accounts receivable is going to provide a lot of the evidence we're going to use here. It's not the only evidence, but it's going to provide a good bit of evidence. And so we would look at the aging, current aging of prior years, or the aging of the current year compared to the aging of the prior year, to see, for example, let's say the prior year the company had a lot in the over 120 days or 61 or 91 to 120 days, and they were trying to make efforts to fix that, right? So did they actually shift more of that balance closer to being current. And so we can compare and see what kind of changes there have been in that process. And then we can also look to see, for example, based on the write-offs, how many of those write-offs for the current year, right? What buckets were they sitting in last year, to get a sense of how many, like what percentage of those buckets might we need to consider as setting aside for the allowance. Okay. So if we look here at, and this is the SUA, actually, the Systems Understanding Aid project. There's an example of the age trial balance. Obviously, this is a trivial example with only 3 customers with balances. In most firms, there's going to be a lot more customers. And so, again, these are the buckets that they would use. You could use more or slightly different buckets, but the point would be trying to get some estimates around, okay, how much of this $1,200 does the firm really expect to get back, right? How much of this, if there was anything in this bucket, how much of this, what percentage of this bucket would we expect to get back, right? What percentage of the 31 to 60? What percentage of the current, right? And if we added all that up, that should give me now what my allowance should be, right? My allowance balance. And so whatever my current allowance balance is, then I would need to adjust it based on what I think what I as the auditor, I would propose that they would adjust it based on what the estimate of the allowance should be, right? So we would look at what the current allowance is relative to our estimate of what we think the allowance should be, and then that would give us a proposed adjustment to the allowance for doubtful accounts. And then lastly, related party transactions. You'll see there's a lot of filings with the SEC that are related, that deal or that include information about related parties and transactions with those related parties. So you can look at in the past what have they identified, but then you would need to look to see in terms of current transactions, whether it's extending credit or giving loans, those kinds of things we would look for. In this case, we're talking about extending receivables, right? Possibly a note receivable in exchange for something else. And so you're going to look for individuals that would fall into this related party, right? That could be consultants and lawyers and board of directors members and executives and all those things. And we would look to see and make sure this is largely going to be a disclosure issue to make sure that those transactions are disclosed so that basically they see the light of day and investors can determine for themselves whether that's reasonable transactions. And then if you want to see, audit documentation, what working papers would be at the end of the day present for AR and sales, you would have lead schedules, one lead schedule for receivables, one lead schedule for revenue, and then you'd have working papers that would support those lead schedules and kind of back up the ultimate conclusion from the auditors around would the auditors are they proposing adjustments to accounts receivable, or proposing adjustments to the allowance account, or proposing adjustments to either gross sales or any of the sales discounts and allowances to get to net sales. And so these would just be supporting documents that you or supporting files, if we're talking about electronic working papers, to support the decision and the work in this area that would ultimately lead to a potential proposed adjustment from the auditors to the client to make the financial statements be free of material misstatements.